Hello, everyone, and welcome to another session of IIFl Securities Leaders Speak. Our keynote speaker for today is Mr. Shyamsunder Bhat. Mr. Shyamsunder Bhat is the CIO of Exide Life Insurance Company Limited. Having joined the company in September 2010, Shyam has an overall experience of over 26 years in fund management. This session will be moderated by Shweta Papriwal, editor at IIFl Securities. Over to you, Shweta.
Hello, Mr. Bhatt. Welcome. It's a privilege to have you grace our listeners today with your valuable insights.
Yep, thank you. Hello, everyone.
Sir, before I go to broad-based questions, let us, start with the budget question, which was a very recent event and which has impacted the markets a lot. So, can you please, give us what is your reaction to the budget 2021 and also what is your take on the budget proposal to raise the foreign direct investment limit in the insurance sector to 74%? Will it help attract overseas capital and enhance insurance penetration in the country?
Uh, Thanks. So to answer your first question on the recent budget, clearly it was a very positive budget, particularly from the equity markets perspective. Uh, Given that what the entire market was hoping for was a growth-oriented budget without too much of dependence on controlling of fiscal deficit. So something which has been clearly a very difficult task in the last few years because the government has kept the fiscal deficit or tried to keep the fiscal deficit in check at the time of presenting the budgets. Or you could have had a scenario where taxation could have been raised to fund the growth. So clearly this time, since we've seen a focus on growth and increase in capital expenditure, uh, and at the same time, except for some marginal changes, no real increase in taxation either on the corporate side or on the personal income tax.
Right.
Thereby, could have been the best kind of a budget with the equity markets could have hoped for. At the same time, yes, so the government has actually taken a stance that we'll go ahead with a higher fiscal deficit than what we would have otherwise wanted to, which meant increased borrowings. And therefore, we have seen a reaction, the opposite reaction from the debt market, exactly opposite to what the equity market has reacted. And both markets have reacted in a rightful manner to the budget proposals. More importantly, I'll actually go a bit further because not just from this year's perspective, but the government appears to have bought time actually for 3 more years in terms of spending for growth. Given that the glide path which has now been given for to reach a fiscal deficit of 4.5% is in FY26, and therefore and this was the last time we were above 4.5%, other than the current year was just last year, which was marginally above, which was at 4.6%. But otherwise, we have been below 4.5% for quite a few years prior to that. And now that the government has projected that the 4.5% will be reached only 3 years later, effectively means that the next 3 years also could be oriented towards growth, being funded through higher borrowings than what we've seen, in the past.
Right.
And therefore, even from the long-term point of view, not just from this year's, the budget therefore has been taken very positively by the equity markets. On your second question, and I'll just add one more point. I think this was one window of opportunity, I think, which the government had, given that many of the large global economies also are likely to spend heavily and have high fiscal deficits, without risking too much the possibility of a downgrade in the sovereign credit rating, because that is something which has been possibly holding back these measures in the past couple of years. So there was this one window which was this year, which clearly the government appears to have utilized this window, and that's very heartening from the economy's perspective, not just from the equity markets perspective. On your second question on the FDI in insurance sector, so clearly that is something which was a long-standing expectation from the industry. It will definitely be very positive from the point of view of many of the companies getting the kind of capital that is needed to drive penetration. So while penetration has been increasing, clearly there is a significant scope still as far as our country is concerned. And this capital will go a long way. What we could see particularly is of smaller companies where we could see the FDI increase happening. Because in many of the listed players, as we know that we have seen actually some of the foreign promoters actually having reduced holdings after they have got listed in the last few years. So while the industry as a whole will benefit, possibly some of the mid and smaller size players could benefit more because they could attract the capital and utilize it to enhance the penetration and their respective growth.
Thank you so much for your insights on the budget and the insurance sector too. My next question would be, what is your near-term view and outlook for 2021 on equity markets? What would you prefer amongst large caps, mid caps, and small caps for the year 2021?
Um, so at the outset, I must say that we have been cautious on the markets over the past few months, primarily because of the kind of valuation that the market was running up to, and because it was significantly driven by foreign liquidity. So it was a largely liquidity-driven rally, which becomes difficult to predict in terms of the longevity or the extent, to which it can drive markets. Because on a fundamental basis, the kind of bounce back that we've seen as far as the economy is concerned and individual corporate earnings are concerned, to a large extent, the recent rally in the last few months had already appeared to have factored that in. So what was needed clearly was something to more on the fundamental ground, which could help actually help corporates to live up to now the heightened expectations of earnings growth that analysts seem to be factoring in. So from that point of view, I think this budget has created that environment in terms of providing the environment for the economy and the corporates to grow. And therefore, while valuations definitely still remain steep and they've got steeper after the rally post budget, but the outlook for the markets has improved. Primarily because it is no longer driven only by liquidity, but now there could be the fundamental levers as well, which could help markets or companies grow over the next 3 years. And this again, which is why I mentioned that possibly one has to look deeper in the budget, not just from this year, but what it has forecasted as a glide path, to possibly look into what we can have for the markets. So net, so if I were to say what our view now is, our markets view on the markets now is more positive than it has been in the past few months, because there is a fundamental reason now getting added rather than being positive only because of the kind of liquidity that was flowing in. That said, because the valuations are now at 18 to 19 times FY23 numbers, which is historically above what we've been quoting at, because now we are talking of 2 years forward earnings. The immediate upside may tend to be restricted as far as the index is concerned. I think the markets will increasingly become more and more stock specific going forward. Because last 6 to 8 months we have seen a broad market rally where of course some of the individual stocks have multiplied even more than 100%. Going forward, that of course may be difficult up from these levels. But to answer your question on large caps, mid caps, and small caps, I think it would continue to be a broad-based rally, but would be difficult to pinpoint as to whether a particular index may do as well, because it's going to become increasingly stock specific, because individual companies will now have to live up to the kind of expectations which analysts are building in, for a 2 year,
Right.
3 year growth.
Right.
So corrections could happen intermittently now because of the valuations. But the environment created by the budget would now create support, on the downside on each of the corrections.
Right. So we are expecting a positive perspective on the stock markets, right?
That's
Sir,
right. That's
any new trends in the terms of sectors which you are seeing that could last for the next couple of quarters?
right. So I wouldn't still like to comment only on a couple of quarters, given that we do take longer term outlooks. Uh, what we've seen, if one were to see what has happened in terms of sectoral movement, so apart from the stock specific movement which I said which would dominate the markets over the next year or so, or 1 year plus, we would keep seeing sectoral rotation as well. Actually, as the market kept driving higher in the last few months, we've seen sectoral rotation happen continuously based on a relative value which investors are seeing amongst sectors. So I think sectoral rotation also will continue. The latest sectoral rotation, obviously, what one has seen is that some of the defensive sectors may tend to underperform, uh, primarily given that their growth may not be commensurate to the high valuations which have been accorded to them because of the defensive nature. So you would have possibly some of the cyclical sectors do better in the near term. The financial sector clearly is something which we are very positive on. That was one sector which had underperformed in the first few months of the rally, which we had seen from April. Uh, uh, the financial sector, of course, caught up with largely with the rest of the market in the last couple of months leading to the budget. And of course, after the budget, we've seen that sector being a major beneficiary. So, given that the expectations on the economy now are far more positive than what they were earlier on in this financial year, and because the financial sector is clearly a big proxy to the overall economy, we think that sector will continue to do well. Uh, Overall, there are a couple of other sectors which clearly from the production-linked incentives or PLI scheme which the government
Yes.
has announced. But there are, yeah, so it is across sectors, but clearly one sector which is expected to be the bigger beneficiary is the electronics, consumer electronics sector, where we've already seen traction happening. Though, of course, there are a limited number of stocks from that sector. For the other sectors, for example, you have the PLI scheme extend to several other sectors like auto, pharma, etc. We need to see as to independently whether really it can create that kind of a demand from the respective sectors, because simultaneously some of the other earlier export incentives have been taken away from those industries. So that remains to be seen. But that is another trend which I think analysts and investors will closely watch, uh, given that it is an attempt also to make to have one or two more sectors from India being globally competitive in terms of size as well, given that it's been a long time since the earlier decades that we've seen any of the new sector from India becoming very large in the global landscape. So in terms of, so to answer your question, the financial sector clearly we expect to do well. A few sectors from the PLI scheme we expect to do well, and some of the sectors which temporarily are taking a backseat because of the sectoral rotation. For example, the pharma sector and even the FMCG sector, which temporarily because of the movement after the budget has taken a backseat in terms of not really rallying as much as the market, we think will remain parts of the portfolio and possibly could attract the next inflow once the sectors which are currently running up, pause because of higher valuations. So I think that sectoral rotation will keep continuing. But what is most important for all sectors and all companies now at current market levels is to, again, as I mentioned earlier, live up to the analyst expectations, because a further re-rating in terms of P multiple is going to become increasingly difficult. And because earnings estimates have already been upgraded massively in the last couple of quarters, it's been one of the biggest upgrade cycles that we've seen. So further upgrades in earnings are going to be difficult. So a P re-rating will happen only if these estimates are being met over the next few quarters.
Right. So our viewers should look for financial sector and some cyclical sectors and the companies which are driven by PLI scheme of the government, right? As Mr. Bhatt mentioned.
Correct, correct. So yeah. So cyclical sector. So in the sense of metal sector, clearly is likely to be a positive sector globally, because globally countries are going to spend in terms of wanting to drive the growth in their economies. Uh, and and in terms of valuations, generally the commodities do tend at lower valuations than
Yeah.
the rest of the market. But that also gives scope for re-rating whenever one sees a multi-year kind of a growth which might happen globally, which will benefit such sectors. So metals clearly among commodities could be one more sector which investors could look out for.
So any key triggers or themes which will, continue supporting the market in 2021 according to you?
Um, So two or three things I'd like to mention here. One is what we've seen is that in terms of domestic funds, for example, the domestic mutual funds have been sellers in the last few months, possibly because of outflows. While we've seen big inflows coming in from foreign funds, what is expected is that as the customer or consumer confidence has been reinforced, we've not seen incremental taxation coming in. Purely sentiment and the feel good factor could lead to investors coming back into mutual funds as well, and we could see recovery on the revival in terms of the ULIP growth as well, as far as the insurance sector is concerned. uh, while we have seen a significant amount of retail activity, possibly direct retail activity in the markets, in this lockdown phase, investors investing through institutions seems to have taken a temporary backseat. But as markets trend higher and the risk levels also in the markets rise, clearly investing through institutions may prove to be a safer option for investors. So what we would also need is a balancing force for the foreign funds. So because clearly because the foreign funds have other options other than India as well. So while India has been a favored option, at some point we could have a reallocation in terms of incremental flows away from India into some of the other emerging markets, or maybe even into partly into the developed markets, in terms of percentages. And then we would clearly need strong domestic inflows in mutual funds and insurance companies to nullify the kind of selling pressure which might emerge at some point of time, as valuations keep rising. So what investors would need to watch out for also will be the kind of inflows that mutual funds and the insurance sector sees, because this balancing force will be required. The second is in terms of there have been a few headline announcements from the government in the budget, which one needs to see whether or not or how soon they can be implemented. For example, the privatization of two PSU banks, which is mentioned, which is clearly going to be a difficult affair. So, apart from, I mean, first we need to see the earlier privatizations which have progressed, but which had got delayed partly due to the pandemic last year. So a positive news flow in terms of one or two out of the three or four identified PSUs for privatization, which were identified prior to the COVID pandemic hitting us last year. That is again a positive news flow, because the government is depending again on 1.75 lakh crore of disinvestment this year. And while some of the taxation targets there might be some cushion there which might make up if there is a shortfall in the disinvestment. But clearly, since the fiscal deficit has already been set at a very high level, from the confidence perspective, I think one or two of the privatization deals of the government going through will again be a positive trigger as far as the markets are concerned. But at the same time, if you do have a big outflow happening from the FIs sometime later in the year, if there are indications in terms of the tapering down of the liquidity in the global markets, by that time it is essential that domestic inflows rise. Otherwise, we could see a sharper correction in the markets.
Correct, correct. And so my last question for you would be any key learnings from the year 2020 and what would you advise investors to follow in 2021?
Um, Yes, so in terms of key learnings, clearly I would say two key learnings. One is, from the longer term point of view, panic situations do tend to be ideal situations to, invest. That clearly we've seen from what happened in March and what happened subsequently post April. The second is one in terms of estimation, that when markets are driven by liquidity, it is difficult to estimate, as I mentioned earlier in the interview, difficult to estimate, the extent to which markets can be driven up, and by the same logic, the extent to which the markets can be driven down as well. Which is why I mentioned that if at all, there is a tapering down of the liquidity and we see a large foreign outflow sometime later in the year, then it will be very difficult to predict the extent of the fall as well, because liquidity driven up moves or down moves can be both sharp and extended. like what we have seen in the last few months. Thirdly, as we all know, I think all of us have learned newer ways of working, which clearly will help us because the adaptation of, I think, people to different situations clearly has come to the fore last year.
Correct. So 2020 has taught us a lot, and sir,
Yeah.
you have actually given
Right.
us a lot of insight.
One last,
Yeah.
yeah. Sorry, one last point. I think while equity markets have risen very sharply, have almost doubled or have actually more than doubled from the lows in March. The 10-year returns, if one sees from equities, are still just in line with what debt has given, because debt markets have had a very good up move in the last few years. So on a 10-year basis, both equity and debt have given returns of in the region of anywhere between 9 to 10% as far as the indices are concerned. Uh, and therefore, and the equity market obviously has underperformed for a reason, because corporate earnings have not grown for the last several years. And for the same very reason, the equity markets may do better than debt if the corporate earnings do deliver over the next few years. And given that we are at the bottom end of the interest rate cycle, so while interest rate may not go up sharply from here, they are not expected to fall either. Partly and largely because of what is happening globally, where interest rates are now rising, and also the high levels of borrowings now expected from the government over the next 3 years. So from the asset allocation point of view between equity and debt, clearly it appears that compared to the last few years, where debt was clearly a better option as compared to equity, we could see it swing the other way, where equity could be a better option than debt. Though, of course, a balanced asset mix in line with the age or risk appetite is what we always suggest for all investors. But in that balance, clearly equity should look like a better option than debt over the next few years compared to the last few.
So we have understood that equity looks like a better option than debt, and there are enough triggers for the stock markets also to continue the rally. So we had like actually a very insightful session with you, and I would like to thank you on behalf of all our listeners for taking time out for this. We hope you enjoyed the session as much as we did. Thank you, sir.
Thank you. Yes, I did. Yeah, thank you. Bye.
Bye bye.